Let's talk about this right now. These tariffs, the president, he puts it out there. There's negotiations and other things. What kind of risk is that to the market? There's also the risk of it when it comes to inflation, or at least inflation expectations. We saw the market sell off on Friday after that University of Michigan Consumer Sentiment report, where the 5-year read on inflation expectations was the highest since 1995. So what risk do these tariffs really put to the market? I do want to keep it in context. The S&P just about 3% from its 52-week high.
That's a good point, Frank. I think first and foremost, we've had a bit of a batch of economic data now over the last, call that 2, 3, 4 weeks that have been a bit less encouraging than they were in Q4. So generally speaking, I mean, to your point of inflation expectations, the 5 to 10-year point in the University of Michigan hitting 3.5%, the highest for a multiple of years, core inflation hitting 0.4% over the month, basically meaning that the Fed is quite uncomfortable both with these inflation readings and certainly at a wait-and-see mode at this point in time. And this comes at a moment where retail sales, PMIs, are also coming down. So the general sort of mix of growth inflation data has been a bit more challenging. And then it's as if that wasn't enough to sort of keep stock markets on their toes. We get a sort of a daily news flow out of the U.S. administration, Donald Trump here with the example of talking about tariffs hitting Europe as well. So this is a time where you certainly want to be diversified. We've seen that U.S. equities that were the lead over the last couple of years have basically been broadening out to see other markets, including actually Europe and China, despite tariffs, doing relatively well. And other segments of assets, such as fixed income, actually performing very well with yields coming down, but also some other diversifying assets, such as gold, doing very well. It's something that we're also holding in portfolios for our clients.
I want to go back to the equity market. When you say diversified, do you mean diversified outside of the U.S., look at other international markets, or you're saying whole commodities like gold and things like that?
So I think it's the mix of all of that, Frank. So we certainly still think that U.S. equities will do well. We have a year-end target on S&P 500 of 6,600. We really like the AI story a bit along the lines of your previous speakers talking about this CapEx spend, just underpinning what I think is extraordinary growth within everything that links to AI, with the 35% up on CapEx spend from the big 4 tech companies that you highlighted before, close to $300 billion. But I think we're seeing that earnings broadening out to other sectors, both in the U.S., so beyond the tech-related firms. But we also see that Europe and China have sort of seen upgrades on their earnings front, which is supporting sort of some of these markets that were trading below traditional valuation. So price-to-earnings ratios now for European equities at 14 times earnings is closer to historical averages. But when we move out, in addition, what I'd also say is that we have seen that fixed income markets are providing that diversification. So it's almost, going despite the logic that with higher inflation numbers, you'd expect to see yields moving up. But what markets are really doing in fixed income, it's saying that the Fed will ultimately move on growth dynamics. And if they were to be slowing, such as the PMIs are indicating, we're going to see the Fed cutting rates, and therefore this rally in fixed income markets. Yeah.
So, Mark, I want to ask you, we are, of course, coming off NVIDIA earnings. We have to talk specifically about tech with you. We were talking about NVIDIA being down since DeepSeek. I'm looking at the Mag 7. That group of stocks also down since DeepSeek, about 8% or so, but, kind of a rebound today. When you're looking at the tech trade, with this NVIDIA earnings report, is this officially, in your mind, is this a kind of a signal to go back into that tech trade, or are there still questions about it?
We see it more as an opportunity than a threat with DeepSeek. So certainly there were some concerns with the CapEx spending. I think that was really the main of it. Is it worth for these big U.S. large tech companies to continue to spend the amount of dollars on chips and similar data centers? But I think everything that we've seen over the last couple of months is basically an upping of those estimates. So they continue to move upwards again in excess of $300 billion of the big 4 tech companies that you were displaying on screen before. So I think that's, if anything, a sort of suggestion that the story is still intact. I think we're going to see revenue coming out of that investing into 2025, lower cost, and I think that's going to be proving as an opportunity for us here.